Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or pass rating on my 33-question research checklist. Today, we're shining the spotlight on Medpace Holdings, ticker symbol MEDP, and uncovering what makes it a potential new investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. First, we will review my investment checklist and database. My 33-question checklist evaluates companies across 9 categories, including fundamentals, management quality, industry position, momentum, historical and future growth, capital allocation, capital structure, and valuation. By doing so, we aim to gain a holistic understanding of a company's strengths, weaknesses, and investment potential. To date, I have screened 208 stocks across 9 sectors and 67 industries, with a mean quality score of 59%, a standard deviation of 15%, and a top quartile benchmark for pass of 70%. 26 companies have passed, 59% have earned a watch, and 15% have failed the checklist. In terms of company size, the distribution is 82% large caps, 17% mid caps, and 1% small caps analyzed. There is also broad sector distribution, with no sector accounting for more than 20% of companies analyzed, and consumer discretionary is the highest at 19%, with communication services the lowest at 4% analyzed. For Medpace, I scored them in April 2024, and data used for this episode is as of the latest quarter, which is Q4 24. So they earned a quality score of 72%, which is in the 79th percentile overall. This is a pass rating. I also like to look at Schwab and Guru Focus for a couple of other benchmarks. Schwab gives them a C rating, while Guru Focus is much more aligned with me, giving them a 95, which is in the 83rd percentile overall and the 84th for their sector. I'll now discuss Medpace's business and industry. They're in the healthcare information and technology industry within the healthcare sector. As of March 17th, their market cap is $9.9 billion, just under that $10 billion large cap designation. Next, I'd like to talk a little bit about their business background and what they sell. They were founded in 1992 by Dr. August Trondel, and Medpace has grown into a leading global contract research organization, or CRO, in the healthcare sector. Unlike biotech firms, Medpace doesn't develop its own drugs, but instead partners with mostly small and mid-sized biotech and pharma companies to execute clinical trials and navigate regulations. As a service business, they claim they differentiate themselves by providing the full service phase 1 through 4 clinical development services and delivering timely and high-quality results to their customers. Some of the services I found that they include are clinical trial management. This essentially is the backbone of their business, and it's where they oversee all aspects of the phase 1 to 4 trials, including patient recruitment and study execution. They also offer laboratory services. Medpace's labs support trials by analyzing samples, ensuring accurate trial design, and conducting statistical analysis. They also can help with regulatory affairs, which includes guiding clients through regulatory approvals and producing essential documentation for approvals. The last service that they do is post-marketing services. So this would be conducting phase 4 studies to monitor drug safety and efficacy after it reaches the market. Medpace's value proposition lies in addressing the issue of drug trial failures, offering a cost-effective solution to clients, allowing them to outsource instead of investing in costly in-house facilities. Their services are essential to the pharmaceutical and biotech industries, as clinical trials are a regulatory requirement for bringing new drugs and medical treatments to the market. Additionally, small and mid-sized biotech and pharma companies often lack the infrastructure and expertise to manage large-scale clinical trials, making their solutions invaluable. Now, with that said, their services would be less essential for large-scale biotech and pharma companies. Medpace has a diverse revenue base, with 6 segments. They refer to these as categories, contributing between 10 and 30% of total revenue, and 5 out of 6 showing year-over-year growth as of 2024. The first and most important segment to the business is oncology. This earned them $651 million in fiscal 24, which was 31% of total revenue, up 11% from 2023. Their next largest segment, metabolic, generated $458 million in fiscal 24, which was 21% of total revenue, and up 22% from 2023. Surprisingly, their other segment generated the third most revenue in fiscal 24 at $431 million, which was around 20% of revenue and up 7% from 2023. There's then 3 more segments: cardiology at $230 million, 11% of total revenue, and up 19% from 2023. There's then central nervous system, or CNS, at $182 million, which was 8% of total revenue and up 14% from 2023. Their 6th segment, AV/AI, or Advanced Analytics and Imaging, was at $156 million in fiscal 24, which was 8% of total revenue and down 4% from 2023. In terms of business geographies and seasonality, the US dominates revenue for Medpace, accounting for about 98% of total revenue for the last 3 fiscal years. While they are the dominant revenue contributor, Europe, particularly Belgium, plays a secondary but notable role in their operations. Belgium represents around 15% of their total property, plant, and equipment, suggesting that Medpace may be setting up or maintaining significant resources such as labs, offices, or specialized clinical equipment in Belgium. In terms of seasonality, there was no seasonality mentioned in their 10K. Let's talk a little bit now about their customer base and market dynamics. Medpace's customer base is somewhat diversified, but there is moderate concentration in the top 10 customers. They focus primarily on small to mid-sized biotech companies, which was 79% of revenue in fiscal 24, while also serving mid-sized biopharma at 17% of total revenues and some larger pharma at only 4% revenues. Their top 10 customers comprise 29% of revenue in fiscal 24, which is something that investors will want to monitor as it's a little high. I then want to talk about my new rating system for the industry section. I'll use 3 different buckets to place a company's industry in, and that is unattractive, neutral, or attractive. Medpace gets a neutral industry rating, which is where growth potential exists, but industry headwinds or volatility creates uncertainty. The CRO industry, particularly in small and mid-sized biotech, remains fairly attractive with strong growth prospects driven by rising R&D costs and the outsourcing of clinical trials. However, the industry is highly sensitive to macroeconomic factors like funding and regulation. Biotech funding has softened since 2022, leading to a 5% drop in ongoing clinical trials, according to FactSet and Jefferies, which has impacted the industry's growth. Medpace is vulnerable to these shifts, which can create volatility in new business awards, backlog growth, and revenue visibility. The Porter's 5 forces to watch here is competition, as there is high competition among CROs. But the good news is that there is a low threat of new entrants and substitutes. This is due to high barriers to entry in terms of expertise and regulatory compliance, as well as the need being high still for specialized high-quality clinical trials. We'll now do a little bit of an industry and company profile. For the industry, the global CRO services market was valued at $86 billion in 2024 and is projected to grow at a 9.3% CAGR, reaching $175 billion by 2032. And this is according to Fortune Business Research. Also, according to a Medpace investor presentation, about $66 billion of that $125 billion annual pharmaceutical spend in the US is outsourced to CROs. Therefore, the small and mid-sized biotech CRO market is valued at about $30 billion, representing Medpace's core focus. Industry trends include increased outsourcing, biotech funding volatility, regulatory and macro sensitivity, and technology and AI integration to streamline clinical trials, improve patient recruitment, and enhance drug development efficiency. For a Medpace company profile, they generated $2.1 billion in revenue in fiscal 24, which was a 12% increase year over year, and they've grown revenue at 20% for the last 5 years. But they did dip significantly in 2024, and 2025 is expected to be an even lower 0 to 4.8% year over year increase. However, analysts have their growth returning to double digits between 2026 and 2028, which would give them a 2025 to 2028 CAGR of 12.5%. This expected CAGR outpaces the industry's projected 9.3% growth rate, indicating that they are positioned to grow faster than the broader CRO market. I also just like to look at their current market share, which is 2.7% on CSImarket.com as of Q4 24, and this is significantly smaller than Icon, which is ticker symbol ICLR at 10.4%, IQVIA, which is ticker symbol IQV, at 19%, and the big player Thermo Fisher Scientific at ticker symbol TMO, and they are 54% market share. The first two are more direct competitors, while Thermo Fisher is a more diversified business. A Medpace June 24 investor presentation has their small mid-sized biopharma market share at a higher 5%, so perhaps they can get to 10 to 20% in the future. The good news is that there does appear to be market share expansion opportunity. Let's then review the competitive environment. Medpace operates in a highly competitive industry and competes with other full-service CROs and in-house R&D departments of biopharma companies. Some competitors include Icon PLC, ticker symbol ICLR. They are a major CRO that provides services to the pharmaceutical, biotech, and medical device industries. There's also Charles River Laboratories, ticker symbol CRL, and they are a leader in laboratory services that supports the drug discovery and development process. The next one, and I'm probably going to pronounce this wrong, Syneos Health, ticker symbol SYNH. They are a biopharma solutions organization that provides integrated solutions to accelerate the delivery of therapies. There's two others I'll talk about, Thermo Fisher Scientific, ticker symbol TMO. They're a dominant player in life sciences and provide a wide range of services, including those in the CRO space. The last one, IQVIA, ticker symbol IQV, they are a global leader in advanced analytics, technology solutions, and contract research services. In terms of customer loyalty and satisfaction, Medpace has a 67% customer loyalty rating and a negative 19 NPS on Comparably, which indicates room for improvement in customer relationships. In contrast, Thermo Fisher has an 81% customer loyalty rating and a plus 23 NPS, while Charles River Laboratories also boasts a high loyalty rating of 77% and a positive plus 3 NPS. Syneos Health and IQVIA have lower loyalty ratings versus Medpace at 57% and 61% respectively, but have higher NPS at 0 and plus 6 respectively. In terms of the financials, I pulled Medpace versus competitors in FinChat, and Medpace outperforms in several key areas with standout gross and free cash flow margins, an impressive $100K in free cash flow per employee, and double-digit free cash flow growth projected at plus 0.99% for the 3-year CAGR. The only area where it looks less attractive versus peers is forward valuation. Next, I'll analyze Medpace's business model and quality growth attributes. Let's start with their revenue model. Medpace generates revenue by winning contracts and charging fees to companies for handling different aspects of the clinical trial process. These contracts are structured based on a fixed fee model or a unit of service model. Fixed fee model is where there is a predetermined price for services rendered, and a unit of service model is pricing based on specific deliverables or tasks completed within the trial process. In terms of revenue recognition, most contracts include an upfront payment at signing, with the remaining fees collected through a billing schedule or upon reaching performance milestones. Given that clinical trials can last several years, Medpace benefits from cash up front, sort of like an Airbnb in my portfolio, and revenue that is recognized over time as they satisfy performance obligations. This creates a recurring, predictable revenue stream once a new contract is signed. The primary source of revenue comes from clinical trial services, which covers all aspects of trial management, from study design and patient recruitment to data analysis and regulatory submission. There are also third-party reimbursables, which is expenses like lab tests incurred on behalf of clients that are later reimbursed, and consulting services, which are additional advisory services. Medpace's revenue growth is influenced by new business awards and their backlog. along with rising demand for clinical trials and their customer mix. If you remember, about 96% of their mix is small to mid biopharma companies. Regulatory changes and trial success rates also impact long-term revenue stability. Let's now talk a little bit about their marketing. According to their 10K, their sales team employs a consultative approach, engaging medical and scientific experts early. Marketing efforts focus on brand awareness, lead generation, and conference participation, supported by analytics-driven sales planning. I'll then look at their pricing power and price elasticity. I've rated their pricing power as moderate. Medpace provides specialized, high-value services, and its pricing power is enhanced by its niche focus on small to mid biotech firms, yet it's also constrained by broader CRO industry competition. I rate their price elasticity as mostly inelastic. Clinical trial services are essential expenditures for biotech and pharmaceutical firms, and delays can be costly. Medpace's full-service model offers critical expertise, making it a necessary investment rather than a discretionary expense for its clients. With that said, there are large biopharma companies that would be less reliant on a Medpace. Medpace's services would typically be categorized under R&D expenses in their customers' income statements, which is good to see because clinical trials are a fundamental part of drug development and regulatory approval processes. I'd now like to take a look at Medpace's quality growth attributes. They receive a green check mark for 5 of the 7 quality growth characteristics that I look for, with the only dings being management and diverse, loyal customer base. And they do also receive 10 out of 11 yeses for the quant questions that we'll review below. So overall, while they're not perfect by any means, they do appear to be a quality growth company. Let's discuss their moat rating a little bit. Morningstar assigns Medpace a narrow moat due to its strong intangible assets and high customer switching cost. The company's focus on late-stage clinical trials, which are complex, multinational, and high stakes, create significant barriers to switching providers mid-trial. Morningstar also notes that Medpace further differentiates itself through a full-service outsourcing model, managing trials end-to-end, which is unlike some competitors that use a functional service provider approach. Morningstar notes that they do lack a wide moat because they primarily serve that small to mid-sized firm, which limits its scale and long-term client lock-in compared to larger CROs with broader pharmaceutical partnerships and deeper competitive entrenchment. We'll now go through the quant section. First, I like to look at returns and predictability. Medpace scores a 3 out of 3 with 1 an A for this section. First question, is annualized price return CAGR greater than the S&P 500 since Portfolio Visualizer tracking began? This is a yes. For Medpace, they have a 33.4% CAGR versus 14.6% for the S&P 500 from September 16 to February 25, with a 0.52 or medium level correlation. The second question, are there any EBIT operating losses over the last 10 years? For Medpace, there are none, which is great to see. I then like to look at whether revenue and EBITDA per share have been predictable over the last 10 years through Guru Focus's predictability ranking. Unfortunately for Medpace, Guru Focus has not rated them, so we'll give them an NA here. The last question of this section looks at the 10-year free cash flow linearity, and if it's at least 0.75. For Medpace, this is yes. Their SBC adjusted free cash flow linearity from 2015 to 2024 is 0.90, while free cash flow per share linearity is 0.84. So they do very well in this returns and predictability section. I then go into 2 profitability questions, and once again, Medpace scores very well with a 2 out of 2. The first question is 10-year average gross margin at least 40%. This is yes. The 2015 to 2024 average for Medpace is 58.6%. It does have a higher standard deviation at 8.5% versus my 3.2% portfolio weighted average, but I think that's because its gross margin has increased by nearly 20% during this time frame. The second question is 10-year average SBC adjusted free cash flow margin at least 15%. For Medpace, this is a yes again, as they average 16.6% during that same time period. And they have a slightly higher standard deviation than my portfolio weighted average of 7.6% to 7.1% for my portfolio. We'll then go on to 3 growth questions, and they get a 3 out of 3 again. The first question is 10-year revenue CAGR at least 5%. Yes, for Medpace. They only have data going back to 2015, so I had to take a 9-year revenue CAGR, and that was 23.3%. We then like to say, okay, well, if revenue is at least 5% CAGR, we want free cash flow per share to be at least a 10% CAGR over that same 10-year time period. And for Medpace, they get another yes. Their free cash flow per share compounded at a slightly higher 24.3%. So we then like to say, okay, well, if they can grow revenue at 5% and free cash flow per share at 10% over the long term, can they also convert net income into free cash flow at least a 75% rate over that same 10-year horizon? For Medpace, this was a yes. Their 2015 to 2024 average is 279% and was never lower than 129%. This is as good as it gets for this metric. I then like to round out this section by looking at 3 questions around value creation, and Medpace scored a 3 out of 3 here. The first question is 10-year average ROIC at least 20%, and ideally higher than its 2024 industry average. Medpace gets a yes. Usually I'll take a combined ROIC, which is stock analysis plus quick FS, but because Medpace has what I call an artificial goodwill, which we'll talk about more in the next section, I had to calculate an adjusted ROIC, which is NOPAT divided by invested capital, but also removing goodwill from total assets. And when you do this, I got a 10-year average of 25%. I then like to see if ROIC is trending up if low, or holding steady if already high. For Medpace, it's already high, but it's also trending up and reached an all-time high of 48% in 2024. The last question for this section looks at, is ROIC consistently greater than the cost of capital, or WACC? Again, Medpace gets a yes here, as the 2020 to 2024 adjusted ROIC to WACC spread was 26%, which is very impressive, especially as I usually like a spread of at least 2%. The industry average spread in 2024 using the NYU database was 3.6%, so they scored very well here. We'll now dive into a high-level overview of Medpace's 3 financial statements. First, the income statement. Like most people, I like to start the income statement with revenue. Medpace shows strong 10-year compounding with a lowered outlook in 2025 that is offset by double-digit growth expectations from 2026 to 2028. They are also highly efficient at generating revenue, scoring in the top quartile for their industry in my revenue per employee metric at $357,000 per employee versus $59,000 for their industry. I'd then like to take a look at margins and COGS. They don't have a gross profit line item on their income statement, which I've noticed confuses several data sources. So S&P Global has their gross margin at 68.8% in 2024 versus 33.2% for NASDAQ. I do think that the 68.8% is right since it connects to their total direct cost line item. But either way, they have strong gross and operating margins well above their industry averages at 68% versus 48% for gross margins and 21% versus 13% for operating margins. Their free cash flow margins have also exceeded 20% the last 6 years. Going down to operating expenses, SG&A is the main one to pay attention to, as it's about 13 to 16% of gross profit the last 5 years. And this is like an all-encompassing line that includes payroll and related employee benefits, sales and marketing expenses, administrative travel, and advertising expenses. Other than that, there's just depreciation and amortization. I'd then like to round out the income statement with looking at net financing cost and interest coverage. For net financing cost, this is interest expense minus interest income divided by net income, and typically the lower percentage the better, and even negative, which would be more interest income than interest expense. For Medpace, their net financing costs have averaged 0 to 2% of net income from 2019 to 2023, which is very low, but that actually flipped in 2024 when they had more interest income, so this is great to see. Next, interest coverage. Medpace has had a really high interest coverage over the last 10 years, averaging 336. Now, the median was lower at 47, but that's still significantly higher than my benchmark of 10 and their current industry median on Guru Focus that is currently at 12.2. There's very little debt payment risk with Medpace. Next, I like to go on to the balance sheet. I like to start by looking at the top assets and liabilities. For assets, cash, goodwill, and accounts receivable together represent 75 to 80% of Medpace's total assets. In 2024, cash emerged as the company's top asset, comprising 31.9% of total assets, surpassing goodwill at 31.5%. This marks a significant shift as goodwill has been steadily declining since 2014, the year that Cinven, I believe I'm pronouncing that correctly, acquired Medpace for $915 million. And after their exit in 2018, Medpace continued to carry $662 million of goodwill on their balance sheet, largely due to that acquisition. Notably, this goodwill is an anomaly, as Medpace is not typically a highly acquisitive company. So while goodwill as a percentage of assets exceeds my 30% benchmark, it remains below the industry average of 42%. And then for accounts receivable, that has grown over the past decade, increasing from 7% to 14% of total assets, reflecting the company's expansion and stronger billing position. Advanced billings, accrued expenses, and operating lease liabilities account for 90% of Medpace's total liabilities. Advanced billings has seen significant growth, rising from 9% of total liabilities in 2015 to 56% in 2024, reflecting the company's strong prepayments for clinical research services. Accrued expenses have remained stable in the low 20% range since 2018, with employee compensation and project-related expenses making up the majority of this category. Operating lease liabilities peaked at around 20% in 2020, but have steadily declined to 10% in 2024. This decrease aligns with Medpace's long-term lease structure, including its Cincinnati headquarter lease, which was renewed in 2023 for 10 years. I also like to use the balance sheet to look at financial stability. And overall, Medpace demonstrates impressive financial stability with a conservative capital structure, strong liquidity, and excellent debt management. The first ratio that I like to look at is debt to equity. This measures capital structure. Medpace's latest quarter debt to equity is 0.18, and their 10-year average is 0.34, both well below my threshold of 1.50 and slightly below or above the current industry median on Guru Focus of 0.24, depending on what time period you use. The next metric that I like to look at is cash to debt, which measures liquidity. Medpace's latest quarter ratio is 4.48, and their 10-year average is 1.43, both of which are above my threshold of 0.75 and the current industry median on Guru Focus of 1.19. The last metric I like to look at for financial stability is debt to free cash flow. This measures a company's debt paydown ability, and generally less than 3 is considered safe. Medpace stands at 0.26, with a 10-year average of 1.41, although it's worth noting that it's been below 1.0 every year since 2018. Finally, let's talk about the cash flow statement. This statement is broken down to 3 areas: operating, financing, and investing activities. In terms of cash flow from operations, their main source of cash inflows is advanced billings, which are prepayments from clients, and this represented about 25% of operating cash flow in 2024. I'll then discuss 3 metrics that I like to look at on the cash flow statement. The first is stock-based compensation intensity. For Medpace, this is low. Their SBC percentage of revenue has consistently been less than 10%, which is my benchmark, and has averaged 2.1% the last 10 years. The 2024 NYU database industry average is 2.9%. It's also only averaged 8% of operating cash flow, which is nice to see. I then like to look at capital intensity, and I'd like CapEx divided by revenue to be less than 5%. For Medpace, this is the case, and they have low capital intensity. Their 10-year average is 2.5% of revenue, and it's also been below the industry average, which was 5.4% as of January 25. Lastly, we'll look at investment intensity. For Medpace, this is medium to high. Investment intensity assesses CapEx divided by depreciation and amortization, so it's sort of that balance between growth and maintenance spending. And a percentage of around 100% indicates that companies are investing in fixed assets at a rate sufficient to maintain their existing business, while anything above is a good sign for future growth. Medpace's 2015 to 2024 average is 90%, which is lower than 100%, but higher than the industry average of 81%. I've given them a medium to high rating, as this investment intensity ratio has actually been over 100% the last 5 years. Let's now discuss Medpace's management and ownership structure. Let's first start with leadership, and I use Simply Wall Street as my main source. First thing I like to know is, are they founder-led? And for Medpace, this is a yes. They are a founder-led business and would be classified as an owner-operator in my classification system. If you remember, this is the most knowledgeable and passionate management team about a business. Dr. Trondell is the CEO and founder, and he has previous experience in clinical development with Novartis and a bunch of other companies, so he has a lot of firsthand industry experience. He has been the CEO and chairman of the board since he founded the company in 1992, which gives him a company tenure of 32.67 years, according to Simply Wall Street. His total yearly compensation is $1.65 million, comprised of 50% base salary and 50% bonuses, which includes company stock and options. He directly owns nearly 18% of total shares outstanding, which is great to see from an investor management alignment perspective. Let's look at some employee reviews now. First, Glassdoor. They scored a 31% recommend to a friend, a 22% approval of CEO, and 32% have a positive business outlook. These are terrible across the board, and Medpace scores among the worst companies of all of the 200 plus companies that I've analyzed. So I also want to take a look at Reddit, and the sentiment there was mostly negative as well. But just to summarize some pros and cons from Glassdoor and Reddit, the main pro of working for Medpace seems to be that it's a good place to get training for the industry, which is great. But the cons outweigh the pros from what I see. They have low pay, high turnover, limited remote work opportunities, bizarre CEO behavior, and this weird non-compete for a year or two after leaving the company. Next, let's talk about compensation. This is slightly less important since insider ownership is so high. But first, let's discuss the compensation structure, and then we'll talk about some KPIs. The CEO and other named executive officers, which they call NEOs, are compensated based on a mix of base salary, annual cash bonus, and long-term incentive awards. The CEO's base salary for 2023 was $814,275, which was about a 5% increase from the prior year. The annual cash bonus is performance-based with no guaranteed payouts, and it's based on 75% tied to financial performance, which breaks down to 50% EBITDA and 25% revenue, while 25% is based on the individual and company's performance. For 2023, the bonus payout to the CEO was 100% of his base salary. For the long-term incentive awards, NEOs must hold 3 times their base salary in stock, and the CEO last received option awards in 2021 worth about $4 million. Overall, Simply Wall Street has the CEO's total compensation of $1.6 million as below average for companies of similar size in the US. And I'm generally okay with the compensation structure, but would really prefer them to use something other than EBITDA with revenue as the 2 KPIs. Next, let's briefly discuss their capital allocation. Morningstar assigns Medpace a standard capital allocation rating, indicating that the company follows a reasonable but not exceptional capital allocation strategy. They note that Medpace's balance sheet is sound and that their investment strategy aligns well with its growth stage business model, prioritizing organic expansion, innovation, and financial flexibility over aggressive acquisitions or dividend payouts. They do wish that the CEO and chair roles were separate, which I agree with. Their 10-year average total shareholder distribution to free cash flow ratio, which is buybacks plus dividends divided by free cash flow, was 41%, which is well below my 100% threshold. Management prioritizes reinvestment back into internal investments to drive organic growth versus returning capital to shareholders, so they don't pay a dividend. They have also been buying back stock each year for the last 5 years. Diluted shares outstanding have slightly increased over the last 10 years, but they have declined by 16% over the last 3 years as buybacks have ramped up. Let's now discuss Medpace's ownership structure. Ideally, I want high insider ownership and high institutional ownership. For Medpace, they clear both benchmarks with insider ownership at 18% on Simply Wall Street, which is above my 10% benchmark, and institutional ownership at 82% on Simply Wall Street, which is also above my 75% benchmark. I'll now evaluate Medpace's key growth areas and risk factors. Each element will be scored on 2 dimensions: the likelihood of occurrence and its potential impact on the business. First, let's discuss their growth areas. The first growth area that I'd like to discuss is rising outsourcing trends, which I have as high likelihood and high impact. The outsourcing of clinical trials has been increasing, with some data showing over 50% of trials now outsourced, and Medpace is well positioned to benefit from this trend, particularly with its focus on small and mid-sized biotech firms that lack those in-house clinical infrastructures. The second growth area is complex therapeutics and specialization, which I have as medium likelihood and high impact. Medpace's expertise in high-growth therapeutic areas, such as oncology, gene therapy, and biologics, positions it as a leader in these fields. And as innovation in these areas accelerates, Medpace's specialized capabilities make it a preferred partner for biotech firms. There's also the growth area of increased R&D spending and funding in general, which I have as medium likelihood and medium impact. The pharma and biotech industries continue to see increased R&D investments over the long term, driving sustainable demand for CROs like Medpace. While funding cycles can be volatile, the long-term trajectory of R&D spending remains positive. Let's now discuss 3 risk factors. First, biotech funding volatility, which I have as high likelihood and high impact. Many of Medpace's clients rely on venture capital and public market funding, which can be very cyclical. The recent downturn in biotech funding has already led to trial cancellations and a prolonged funding squeeze that will impact Medpace's revenue pipeline. There's also competition and the AI adoption lag, which I have as medium likelihood and high impact. From the research I found, competitors like IQVIA and ICON have aggressively integrated AI-driven clinical trial management, while Medpace appears to be slower to adopt such technologies. So if the industry moves toward AI-powered efficiencies at a rapid pace, Medpace may face a competitive disadvantage. There's then the risk of regulatory and compliance, which I have as medium likelihood and medium impact. The clinical trial industry is very highly regulated, with evolving FDA and EMA requirements. So any major regulatory change could increase costs and timelines, making trial execution more complex and impacting Medpace's profitability. Overall, Medpace's growth areas provide a solid foundation for long-term expansion. However, the risk, especially biotech funding volatility and competitive pressures from AI-driven CROs, cannot be ignored. While Medpace is positioned well to benefit from industry trends, its reliance on smaller to medium biotech firms makes it more vulnerable to market downturns. Overall, the company's growth potential outweighs the risk in a stable funding environment, but any prolonged biotech funding squeeze will definitely dampen its momentum. Before we get to valuation, I want to briefly discuss 2 key metrics that I would track for Medpace. The first is their net book to bill. This is a leading indicator of future revenue growth. A ratio above 1 means Medpace is winning more business than it's completing, signaling strong demand. However, the downtrend over the last 5 years from 1.27 to 1.06 suggests a slowdown, which is definitely worth monitoring. The second KPI that I'd look at is net new business awards, as this directly reflects Medpace's ability to secure new contracts while factoring in cancellations. A declining trend here could indicate weakening demand or increased client uncertainty, impacting future revenue growth. In 2024, their net new business awards declined by 5.4% from $2.36 billion to $2.23 billion. There's also 2 other efficiency metrics that you can look at for Medpace, and those are backlog conversion rate and net new business awards per employee. The last section, valuation and technical analysis, will assess Medpace's intrinsic and relative value, while also examining key technical indicators for ideal entry ranges. The first thing that I like to look at for valuation is the company's business lifecycle stage. They are still in the growth phase, although there is a temporary slowdown in 2025, and they're highly profitable, so it's okay to use free cash flow-based valuation methods, as well as EV to EBIT for multiples. So the first method that I'll talk about for Medpace is the DCF, with investorsgrow.com as my source. I used a 9% discount rate, a 2.5% perpetual growth rate, and 4 years of analyst free cash flow forecast, 15 total analysts, and Medpace's fair value is $339, which is 4% undervalued versus current price of $327 This implies a 9 to 10% IRR. The next method what we use is a reverse DCF from my own spreadsheet. And Medpace here needs free cash flow per share to grow between 2.5% and 4.7% per year for the next 10 years to justify its current price. And this depends on whether you give them a terminal price to free cash flow multiple of 15 or 20. Their current multiple is at 17. I've also used trailing 12-month free cash flow per share of $17.88. Although if you use a 5-year normalized figure at $12.60, that still gets you an implied growth rate of 9.4% with a terminal multiple of 15, which is very attractive given their historical averages of a 3-year compounded growth rate of 42%, 5-year 30%, and 10-year 26%. Next, we'll look at an SBC adjusted free cash flow yield valuation, also from my own spreadsheet. Using trailing 12-month Q4 24 data, free cash flow yield is 5.58%, which is greater than the 4.75% 10-year average. 2025 forward free cash flow yield is lower at 3.91% due to analyst estimates of a lower free cash flow in 2025 of only $391 million. It's important here, I think, to focus on the 2025 forward free cash flow yield, as it reflects Medpace's current outlook, which projects a decline in free cash flow. Based on a current price of $327 and latest quarter net cash debt of $520 million, I estimate the 2025 forward free cash flow yield to give us a current price of $308, which would be 6% overvalued. Lastly, I'll look at an EV to EBIT multiple from Guru Focus. Medpace's current multiple is 20.6 as of trailing 12-month Q4 24, which is less than the 27.5 10-year median and slightly higher than the 19.4 medical diagnostics and research industry median. Their 10-year median multiple implies a stock price of $404, which would be 23% undervalued. Overall, Medpace appears moderately undervalued based on various valuation methods. The DCF model suggests a 4% undervaluation, while the reverse DCF indicates a very reasonable growth rate for free cash flow per share of 9 to 10%. The free cash flow yield approach has them at 6% overvalued. The EV to EBIT multiple suggests a 23% undervaluation. Therefore, it seems like Medpace is between either 6% overvalued to 23% undervalued. Now looking at a little bit of technical analysis, Medpace remains in a long-term uptrend, with the current price of $327 above the 5-year 200-day exponential moving average of $264. However, over the past year, it has been in a downtrend, with current price trading below its 20, 50, 100, and 200-day exponential moving averages. Based on my stage identification model, Medpace is likely transitioning between a stage 4 downtrend and a stage 1 base, which typically isn't an optimal entry point. And its next key support level is the 5-year 100-day exponential moving average at $317. Looking at Medpace's short interest is relatively low at 6% of the float per market beat. A reading above 10% would indicate growing bearish sentiment. So despite the downtrend in the last year, this is good to see. I'd then like to do a little bit of volume analysis. And using an anchored volume profile, historical buying activity was highest between $150 and $220 over the past 5 years, but more recently in the last year, the most active price range has shifted to $320 to around $350, hinting at a potential battle between buyers and sellers at current levels. I then am adding a new section called Insider Buying and Selling Activity. The source is investorsgrow.com, and I thought it was interesting that Investors Grow has more insider buys than sells for Medpace over the last 3 and 12 months, at 104,000 and 32,000 net activity respectively. Medpace's long-term trend remains intact, but with short-term weakness and key support nearby, investors may want to wait for a trend reversal before considering an entry. Overall, Medpace meets my criteria for a quality growth company, but that hinges on 2025 being an anomaly and a return to double-digit growth in 2026 and beyond. They are an intriguing outlier in the healthcare sector, which is not typically associated with higher growth. Their pricing power is a plus, but they lack true market leadership due to their small to mid-sized focus. Additionally, their narrow moat, US-heavy revenue base, and reliance on biopharma funding introduce risk, making a margin of safety essential. Management also receives poor Glassdoor ratings, which raises concerns about internal culture and leadership. So what's my investment strategy? Medpace appears modestly undervalued, but technical indicators suggest caution. With a full portfolio, I'm adding Medpace to my watch list and will wait to see if it tests support at 317 or clears 346 for confirmation before considering a position. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of Medpace both insightful and actionable. If you enjoyed today's episode, please subscribe, leave a rating, drop a comment, or take the episode poll. For real-time updates and insights, follow me on X at Invest091. Join me next in May when we'll dive into FactSet Research Systems, ticker symbol FDS. Until then, keep your investments smart.